First ratio is called interest coverage ratio, right? So what is interest coverage ratio? It tells us that how much interest, in the numerator you can see EBIT, in the denominator you can see interest expense, right? It tells us how much easily company can pay it interest, right? So that is what interest coverage ratio tells us. Obviously company has borrowed money, so obviously it will have to pay interest, right? So how much easily company is able to do the interest payment, that is what interest coverage ratio tells us, right? And the formula is EBIT upon interest expense. So what does EBIT indicate? EBIT indicate the net profit before interest, paying interest and tax, and from that profit only from that earning only company will be paying interest. So more EBIT, so more ability to pay interest. So EBIT upon interest expense is called interest coverage ratio. Then we have equity multiplier. So what does equity multiplier tells us? It also tells us how easily company can make it interest payment. Higher the equity multiplier, if we talk about the equity multiplier, it shows us as a total asset upon total equity, right? That means how much asset, right, is getting funded by equity, right? So if it is more, it means leverage is also higher, right? If more asset is funding by equity, it means our leverage is also higher. Then we have debt EBITDA ratio. So what does debt EBITDA ratio means? Means how much early company can repay its loan using it earning. That is debt to EBITDA ratio, right? So if this ratio is lower, it means better financial health. So basically what this ratio tells us, how easily company can pay back its loan using it earning. So EBITDA is the earning and debt is the total debt it has taken. So if this ratio is lower, it means that it is better financial, it shows better financial health. Then we have debt equity ratio. So as the name itself suggests, it compares debt and honors equity. So if debt portion is higher, it means risk is more. Then we have debt to asset ratio. So this ratio tells us how much portion of the company's asset is funded by the debt, right? Again, the lower the ratio, the better it is, right? So you see, we have discussed 5 different ratios. On those ratios where debt is in numerator, that ratio should be lower, right? And for those ratio where interest expense EBIT is in numerator, those ratios should be higher. That is the basic funda. So these 5 ratio when combined, right, they decide the financial structure of a company, right? So interest coverage ratio means how easily company can pay back its interest using it earning. Equity multiplier means how much of the asset is funded by the equity, because to fund asset either we use equity or we use the debt, right? So equity multiplier, I told you the equity multiplier, if it is higher, it means leverage is also higher. Then we have debt the debt EBITDA ratio means how much it basically it shows that how early company can pay back its debt using it earning. If this ratio is lower, better financial health. Debt equity ratio, debt and honor contribution comparison is being done using this ratio. And debt asset ratio, that means how much of the asset is funded by the debt. Like debt equity ratio, similarly we have debt asset ratio. Lower it is better. Now friends, let's shift our focus to the financial leverage, right? So we have discussed 5 ratios earlier, financial leverage ratio. Now financial leverage, you can think of it like double-edged sword. It amplifies your return on equity when used wisely, but if you overuse it, especially by large firm, it can be dangerous. So what happened? So that is why I have written double-edged sword, right? Why it is double-edged sword? I told you now, right? It can amplify your return on equity. This ROE means return on equity. It can increase your return on equity if you use it wisely. But if you overuse it, by large firm, what they do, they overuse it. It can be dangerous. A small business might tolerate higher leverage, but larger corporation need to treat cautiously, right? So that is why optimal mix is required. Mixing between equity and debt is optimal. It should be required, right? So the goal is to strike the optimal mix between equity and debt, and that is where CBA. What is CBA? Cost benefit analysis. and proper funding strategy comes into play. Then we have something called risk management. So risk management is all about balancing gain with stability. You can see balancing risk and return in leverage. So risk management is all about you are balancing gain with potential gain with financial stability. So more debt, it means more profit, but only if managed smartly. Suppose you have taken more debt. Oh, you are happy that yes, I have more profit. But yes, but remember, at the back of mind, you must keep in mind, if you manage that debt smartly, then only it is profitable. Otherwise, it will not be profitable. You have to manage that debt smartly. Right, now comes degree of financial leverage. It is a tool that shows how sensitive earning per share is to the change in the operating income. So the formula is percentage change in EPS upon percentage change in EBIT, and here is the simplified version. Right, what is the simplified version? That if interest is fixed, then we can write DFL is equal to EBIT upon EBT. You can see it here, since interest is fixed, right? So delta EBIT is equal to EBI per delta EBT. So the final formula is, you must remember this formula, EBIT upon EBT, right? So that is earning before interest and tax divided by earning before tax. And finally, some more important formula that will help you to solve the problem is that suppose sales is given, variable cost is given, fixed cost is given, you have been asked to calculate EBIT, how to go about doing that? So what you do, first of all, you take the sale, you subtract variable cost, and you also subtract the fixed cost excluding interest. Right, you also subtract the fixed cost from that, and then you will get EBIT. And suppose we know the EBIT, how to get EBT? Quite simple. EBIT means what? Earning before interest and tax. EBT means what? Earning before tax. So just subtract the interest from EBIT, we will get EBT. So these two formula will be very useful to you, right, while doing the calculation, while calculating the DFL. Right, so remember these two formula, very important from examination point of view. So to summarize the fact that we have covered in this particular slide, let me tell you that this financial leverage, it can be your best friend or it can be your biggest risk. Handle it with insight and it can drive powerful growth. Now friends, so I hope this financial leverage concept is clear. Then comes degree of financial leverage. So after financial leverage, the next important topic is degree of financial leverage. What is the meaning of degree of financial leverage? Let's understand. So friends, basically, there are three scenarios here. First scenario on the left hand side is there when there is no interest. So when no interest, what will happen? EBIT is equal to EBT, because no interest is there, no debt part is there. No interest means what? You have not taken any debt, hence no interest to pay. In that case, DFL will be equal to 1. This means there is no leverage effect. So this interpretation should be there. You should know what is the meaning of DFL is equal to 1. So whenever DFL is equal to 1, it means EBIT and EBT both are equal. It means that no debt has been taken, no leverage effect is there, profit change in line with the operating income, safe but limited upside. It is quite safe, but there is no chance of gaining too much. So that is why upside is limited. Right, okay. Now this is situation number 2, that is called break even. So break even means what? Break even means neither profit nor loss. Right, you are neither making profit, you are not making loss. Right, so what will happen? What will happen in this case? Your EBIT, which is your earning, which be exactly equal to the interest. Interest means the cost you are paying. Because you have taken debt, obviously you are paying interest on that is the cost you are paying, and EBIT is your earning. So what I told you, break even, no profit, no loss. Right, so no profit, no loss means what? Whatever cost you are incurring and whatever sales you are getting, both are same. Cost price is equal to selling price. That is what it is happening here. Right, and tell me what will happen to the DFL? So DFL is what? EBIT upon EBT, and EBT is 0. Obviously EBT is 0, earning before tax is 0. Right, so EBT is 0. Since EBT is 0, it means denominator is 0, and denominator means 0 is undefined. It means it is undefined. So this is the maximum risk zone. This is called maximum risk zone. Even a tiny dip in EBIT can lead to huge loss. Suppose EBIT decreases a little, it will lead to huge loss, a dangerous place for any business. So break even point is the dangerous place for any business. This is the situation number 2. And the third situation you have, suppose it is operating below the break even. So break even below means what? It is undergoing loss. So loss means what? Interest cost is higher than the EBIT, isn't it? So before break even means EBIT is positive, but EBT turned negative due to high interest cost. See, interest cost is higher, EBIT is lower, ultimately EBT is become negative, right? That's why it is written EBT is less than 0, EBIT is greater than 0, interest cost is quite higher. So what will happen in this case? DFL will become negative, right? It will become negative because it is a ratio of EBIT upon EBT. So out of, you can see EBT is negative, so DFL will be negative. So this signal what? Loss amplification, means leverage is hurting you, right? It is not helping, it is hurting you. That is why I told you na, leverage is a double-edged sword. If you use it smartly, then it can be very helpful, but if you use if you don't use it smartly, it will be very much hurtful, like you can see in this case. So it, since your since it is operating below the break even point, right, in this case you can see DFL is negative, your loss will become amplified. So more debt if you take, it increase loss instead of gain. So what we learned from this discussion is that it has been simply represented in the form of this chart, is that leverage can be a powerful financial tool, but only when used within the safe limit. Knowing where you are in this scenario help you manage risk smartly. So this break even point decide if you are above the break even, or if you are at least at the break even, you are safe. But if you go below the break even, you are unsafe. That means your DFL will become negative, your loss will get amplified. So this break even acts like a the brake, right? It acts like speed brake. It acts like your speed brake. If you go beyond the break even point, if you go in the negative side, you will be ultimately at loss. I hope that makes sense to you. Now friends, understanding the DOL, DFL we have covered completely, every aspect we have touched now. So now let's understand the DOL, degree of operating leverage. So degree of operating leverage can be understood very well using this particular diagram. So first of all, we will look at the formula. So DOL measure how sensitive a company operating income. So what is the meaning of DOL? It shows how sensitive a company operating income. So what is the meaning of company operating income? It means EBIT, earning before interest and tax. How sensitive a company operating income, that is EBIT, is to the change in sales. That is what is shown by DOL, degree of operating leverage. In simple term, if your sale move 1%, how much will your profit move? That is what DOL tells us, right? So again I am repeating, the formula is percentage change in EBIT upon percentage change in sales quantity. Means if your sales move 1%, how much will your profit move? That is what is indicated by the degree of operating leverage. Now friends, higher DOL, it means higher risk, higher reward. It signal higher fixed cost. It signal greater earning volatility. There are some key formula which we must keep in our mind. The first thing is contribution. I already told you that it is nothing but sales minus variable cost. Then the next formula we have DOL always reflect the operating risk. And then we have the fixed cost. What is fixed cost? What is the meaning of fixed cost? So fixed cost is the main driver. They stay the same even if your sales does not, right? Obviously fixed cost does not get impacted by the sale. Whatever your sales is, fixed cost will remain the same. So you should know how to calculate the contribution, because to calculate basically DOL, you will need to have contribution clear. Contribution concept should be clear, right? So percentage change in EBIT upon percentage change in sale, and EBIT you can write like sales quantity multiplied by price minus variable cost and subtract the fixed cost from it, right? So there is something called refined DOL formula, right? So you can say delta EBIT, or means change in EBIT, is equal to change in sale quantity multiplied by price into price minus variable cost. And finally, this is the super important formula that will help you to calculate, which is nothing but contribution upon EBIT, right? DOL. Like in the case of DFL, I told you the EBIT upon EBT. Similarly here, contribution upon EBIT. This is the final refined formula, and this formula we will be using most of the time. So understanding DOL help business plan better, price smarter, and prepare for the market shift. So if your DOL is higher, what does it mean? It means that your profit can skyrocket with a small sales jump, but it can also fall sharply if sale drop, right? So your suppose DOL is higher, it simply means that your profit can skyrocket with a small sale jump, but it can also fall sharply if sale dip, right? So that is the implication of DOL. Now the most important thing, how to interpret degree of operating leverage in a special situation. This is very important thing. So let's decode DOL when things get extreme. Let's explore how the degree of operating leverage behave in two very special and very opposite situation. The scenario number one is having no fixed cost, right? Having no fixed cost. So what does it mean? When a business has no fixed cost, it run purely on variable expense, right? Since there is no fixed cost, so it will run purely on variable cost or variable expense. In this case, DOL is 1, meaning there is no operating leverage, right? So when no fixed cost is there, which means business is purely running on variable cost, in that case DOL is 1, means that no operating leverage is there. The question is why no operating leverage? Because your profit move exactly in synchronization with your sale, so no acceleration effect is there. So it is a safe zone. That is why I have highlighted by green color. It is safe zone, low risk but also low potential for profit boost from increased sale. Obviously it is why it is called safe zone, because risk is very low, and but since risk is low, but potential for profit is also very low from boost from increased sale. Then scenario number 2 is EBIT is 0. This is very important thing. Now flip to the other extreme, when your business earn no operating income at all. No operating income earned by your business. Now the formula, you know it very well. The formula is contribution upon EBIT. Just now I told you. So when EBIT is 0, means denominator is 0, so the DOL will become undefined, isn't it? DOL will become undefined, right? Since you divide by 0 in the formula, the result is impossible to quantify. That means maximum operating risk. A tiny drop in sale could send you into loss instantly. You are walking a financial tightrope, right? So this is called maximum operating risk. A teeny drop in sale could send you loss instantly, right? And you are walking a financial tightrope. So basically what we learned from this discussion is that, let's summarize the fact that DOL tells you how much pure profit react to the change in sale. But in these are two extreme cases. On one side we have no fixed cost when DOL is equal to 1. So on the other side we have EBT is equal to 0 where DOL is undefined. So in this extreme case, right, so DOL basically tells you how your profit react to the change in sale. But in these extreme cases, the message is clear. No fixed cost, you are stable. No EBIT, you are in danger. That's it. So this is the best way to learn, right? To comprehend the thing, to remember it for the long time. And if before the examination, if you go through these kinds of slides, you will be able to recall the main points, right? Now friends, have a look at this particular slide. How to manage leverage and fixed cost. Very important aspect. Here we will look at something called break-even point. I think you are familiar with it. So when it comes to running a business, the balance between risk and return often hinges on two key factors. The first is called leverage and the fixed cost. Yes, these are the two key factors, leverage and the fixed cost. Let's understand what are these two key factors here. So basically, first of all, let's talk about the high leverage case. See what happened. What is the meaning of high leverage? It means you are using more borrowed fund or fixed financial obligation. So whenever you are using more borrowed fund or whenever you are using fixed financial obligation, it pushes your break-even point higher, right? It pushes the break-even point higher. This increases the risk. Okay, but it also opens the door to higher profit when things goes right. You can think of it as high risk, high reward. This is called high leverage. So I hope the meaning of high leverage is clear. That means you are using more borrowed fund or fixed financial obligation, right? So this more borrowed fund or fixed financial obligation pushes your break-even point higher, increases the risk, but also open the door to higher profit when things goes right. Then we have low leverage. Low leverage means you are playing it safer with few financial obligation. It lower your break-even point and reduces the risk, but your return may also stay modest, ideal for a steady and stable growth. Then we have high fixed cost. So more fixed costs like rent, salary, equipment means your business becoming more sensitive to the change in sales, right? Your business is becoming more sensitive to the change in sales. So this amplify both gain and as well as loss, a classic feature of high operating leverage. And low fixed cost, Right, I told you, when zero fixed cost was there, DUL was exactly equal to 1. So low fixed cost means what? Reducing fixed expense add flexibility. It stabilizes your earning, cushioning both profit and loss. This is a strategic move during uncertain time. So the bottom line is that from this discussion what we get to know is that mastering leverage and fixed cost is not just about math. It's about making a smart decision that match your risk appetite and business goal. Right, I hope that makes sense to you. Now friends, have a look at the combined leverage. In this particular slide we will understand it. So what combined leverage is all about, it has been depicted clearly in this particular slide. So this metric that is the combined leverage tells us total risk exposure of a business. Right, it combines both operating and financial leverage. It tells you the total risk exposure of a business, total risk impact. As you can see, total risk impact or total risk exposure of a business. Right, so it combines both, right? It combines your operating and financial leverage. So if we talk about the impact, on the left hand side you can see DTL stands for degree of total leverage. It captured the full risk impact by considering the operating fixed cost like rent and salary, and financial fixed costs like loan interest. Now, a high DTL, it means that even a small change in sale can cause big swing in the earning per share. It is both a great opportunity but a big risk also. Now, have a look at the formula. Right, there are three ways to calculate DTL. First of all, percentage change in EBIT upon percentage change in sales. This is the first formula. Second formula is either you calculate DFL individually, DUL individually, and multiply both of them. And the third thing you can do, DFL, DFL is EBIT upon EBT, DUL is contribution upon EBIT. So EBIT will get cancelled, it will be contribution upon EBT. So there are three formula which you can use to compute DTL. I use, depending on the situation, what is given to you in the question, you can choose the either of this formula. No matter which one you use, it's all about understanding how sensitive your profit are to the change in sale. That's it. Right, now what is components, what are the things inside it? First of all, we have operating fixed cost, means cost that don't change with production. Then we have financial fixed cost, means payment like loan interest that are due no matter what. So together they define your company total leverage position. So combined leverage is like driving with both the gas pedal and turbo engaged. The reward can be huge, but so can be the risk. So handle it with insights. Now friends, that is all we need to learn from this particular chapter. I have provided you information regarding DFL, its implication, when it becomes DFAT calculation. So first of all, cash forecasting. Cash forecasting help predict your company's future cash position. It is not just about guessing, it's a strategic planning rooted in data. Let's explore the core driver. The first one we have is called sales inflow. Right, as you can see, sales inflow means revenue from sale and customer order. It is the lifeblood of your forecast. A strong inflow, it means healthy business. Right, then we have next we have is called service inflow. So then after sales inflow comes service inflow. So here you can see service inflow on the right hand side. So don't overlook service fee and contract. They provide a steady stream of income and help project recurring cash. Then we have market penetration. As you can see, market penetration on the top right side. So market penetration means knowing your target market and distribution channel help estimate how much cash your business will generate in the new market. Then we have demand estimate. So demand estimate means through research and survey you can forecast customer demand and plan cash need accurately. Then we have competition. Yes, competition always plays a super important role. So what is the meaning of competition? As you can see on the top left side. So competition means what? Analyzing market share and rival ensure you stay ahead and plan for price war or volume change. Then we have something called production plan. Production plan means your capacity, your inventory. They dictate how much you can sell and how much cash you will need or generate. Then we have raw material availability. Inventory level as well as supplier relation affect your production and ultimately your cash outflow. Then we have pricing strategy, which means cost plus or competitive pricing affect your margin and therefore your cash position. And finally, working capital. So the balance between current asset and liability determine how flexible and resilient your business is. So that is all about cash forecasting, right? So by combining all this factor, business can accurately estimate CFAT. What is CFAT? CFAT is cash flow after tax, which is very crucial for investment planning and financial health. So these are the factors which affect our cash forecasting. Now have a look at how do we calculate the CFAT. So there is a step-by-step process I will tell you to calculate the cash flow after the tax. So ever wondered how business actually calculate the cash they truly earn after paying tax? Because the name itself suggests cash flow after the tax. So they have paid the tax. So how do they calculate the cash, right, they truly earn? So let's break it down in the simplest way. First of all, we start with something called sales, right? As you can see, we start with the sale, then we subtract the variable cost. What is variable cost? Like raw material cost or direct labor cost. These are the variable cost. So start with sales value, subtract the variable cost, right, and that you are left with something called contribution, right? So what is your contribution? Contribution means your profit before covering the fixed cost. So sales value minus variable cost, this will give you contribution. From contribution you subtract what? From contribution you subtract your fixed cost, right? So why you subtract the fixed cost? Because these are the costs that don't change with the production. And what are example of fixed cost? Like rent, like salaries. These are the example of fixed cost, right? So you determine the contribution by subtracting sales value minus variable cost, and from contribution you subtract the fixed cost, right? So after subtracting the fixed cost you will get EBIT. What you will get? You will get EBT, earning before tax, right? Earning before tax. And and one more thing that you have to subtract is the depreciation, right? So it is simply your contribution minus fixed cost and depreciation. So contribution minus fixed cost plus depreciation will give you EBT, earning before tax, right? Now time to pay the tax, right? So subtract tax from EBT to get EAT. So if you subtract tax from EBT you will get earning after tax. But here is the twist. The twist is that depreciation is a non-cash expense. So to get the true cash flow, we add the depreciation back. So first of all we subtracted the depreciation and again we add the depreciation because it is a kind of non-cash expense, right? So the result you get is called CFAT, that is called cash flow after the tax. This is the amount of real cash that the business generate. So basically this funnel system, I have prepared this funnel system. So this funnel system show how money flow down through the financial system of a business from total sale to the actual usable cash. So again, just let me summarize. You start with the sale, subtract the variable cost, get the contribution. From contribution you subtract the fixed cost as well as any depreciation. Then you will get EBT. From EBT you subtract the tax, you get EAT, earning after the tax, and from earning after the tax you add again the depreciation, then you will get CFAT. This is the cash flow generated after the cash flow after tax. And this calculation will be super helpful while dealing with cash inflow, cash outflow, right, type of transaction. That is called cash flow after the tax. Now have a look at this particular diagram, that is called payback period method. So let's understand each and every aspect related to the payback period, right? What are limitation, what are advantage, what are disadvantage, every aspect. See, when you invest money into a project, one of the first question that come to the mind is, when will I get my money back? Obviously. So suppose you have invested 2 lakh rupees into your project. So the first question that comes into your mind while investment is that when I will get that 2 lakh rupees back. So that is where payback period comes into picture. In short we call it PP. So PP, that means payback period, is the time it takes to recover your initial investment using net cash inflow, right? So using net cash inflow, how much time does it take to recover your initial investment? That is called PP. The formula is quite simple. In the numerator you write your initial investment, in the denominator you write the annual net cash inflow. So this will give you the time period after which you will be able to receive your cash inflow, right? Your investment amount. But if you want to be more precise, we use discounted payback period, because obviously the time value of money comes into play, right? Because the 1 rupee value today is worth more than 1 rupee value after a year. You know it very well. That is why we apply the concept of discounting. Because discounting payback period, in short we call it DPP, it factor in the time value of money, giving you a more realistic view of the return. Because payback period simply ignore the time value of money, but the discounted payback period, it takes into consideration, right? So suppose if your project generate equal inflow, the calculation is very easy and consistent. Suppose every year you are getting how much? You are getting 50,000 as cash inflow, and you have invested 2 lakh. So obviously after 4 years you will be able to get back your investment, isn't it? But we are not taking time value of money into consideration here. So that is why I am telling you that the formula is very simple. If our cash inflow is constant, right? But suppose our cash inflow is not constant, uneven inflow. Some year you are getting 50,000, some year you are getting 40,000 cash inflow, some year you are getting 30,000. This is called uneven inflow. In that case you need to accumulate cash year by year until the investment is recovered. In that particular case, cumulative cash inflow is very important thing, right? So what we do, we add cumulative net cash inflow year by year until it is equal to the initial investment, right? Like 50,000 plus 40,000 plus 30,000, we add it till it equal to 2 lakh, which is our initial investment, right? So this is the point which you have to remember. So some key points remember regarding the payback period method. It is simple and very fast method, perfect for a small business. However, it does not consider profitability beyond the payback point, and it ignores the time value of money unless you are using DPP, right? That is called discounted payback period. For larger or long-term project, firm often prefer NPV, IRR or ROI for better insight. For a smaller project, this method looks good, but for larger project, this method will not work. That is one of the limitation. So you should know what is payback period. You should know where it is used, where it is not used, right? So the bottom line is that shorter payback period, it means lower risk and faster return, but always pair it with deeper analysis when stakes are high, because we can't apply this payback period method even in a very large business, otherwise, because this will not give the accurate result. Now let's understand the second kind of investment tool we have, that is called accounting rate of return. So basically this is another tool that we can use to check our return on investment. That is called accounting rate of return. In short we call it ARR. So let's explore one of the most classic and straightforward investment evaluation tool. Yes, we are discussing investment evaluation tool. We have done the investment and we are evaluating, right? So the tool we have is called accounting rate of return, ARR. How to find the ARR? Very simple. So to find the ARR is very simple, as you can see the formula here. So in the numerator you write the average annual accounting profit, right? In the denominator you write the initial investment. So average annual accounting profit divided by the initial investment, this will give you the accounting rate of return. Simple, right? But let's look deeper. If you look at the focus, so ARR put the spotlight on profit, not cash flow. In the case of PP, that is payback period, we look at the cash flow, but in this case it focus on profit. It does not focus on the cash flow. That is great for traditional business used to looking at accounting profit. That's why we are dividing the annual profit by the initial investment. In the previous case what we did, we divided by the initial investment by the net cash flow, but in this case we are comparing investment with respect to the profit. Now if you look at the data source, so from where we get the data, so it rely on data from your accounting book, not discounted cash flow. It rely on the data from your accounting book. And what about the time value of money? Yes, that is where ARR falls short. This is a disadvantage of ARR because it ignores the time value of money. Obviously a rupee today is treated same as a rupee 5 years from now, and this is one of the limitation of this ARR, right? If we talk about the estimation period, so ARR work within a limited time frame which may not capture the full project picture. Now what if you look at the practicality of ARR? When it is practical, try to understand. When project life is long, it is practical. When future cash flow are uncertain, it is practical. When you want a quick familiar snapshot, not a deep financial analysis, this ARR is practical, right? If you look at the limitation and flaw, right, if you look at the limitation and flaw, so you can see it is not suitable for cash based evaluation, right? And one more thing, it overemphasizes the latter stage profit, and also internal mismatch is there, comparing shareholder profit with total investment. Obviously that is what we are doing now. On one side we have profit, on the other side we have investment. It can distort the decision, right? So one example is given in your book. Suppose two projects with the same ARR of 40%, but one returned faster than the other, and yet ARR treat them the same, right? ARR treat both of them as the same. It does not reward early gain, which are more valuable, right? Because two projects are there, same ARR 40%, but one returned faster than the other, but ARR treat both as the same. So it does not reward early gain. Obviously, early gain is more favorable to you, right? Which is more valuable. So while ARR is easy, familiar and profit focused, we should use it with caution, right? It is best paired with deeper method like DCF when accuracy really matter. DCF, discounted cash flow method, which we are going to discuss now. So ARR concept I think is clear now. Then we have the next investment evaluation tool, that is called the net present value, or we call it NPV. In short, we call it NPV, net present value. So let's understand what net present value is all about using this particular diagram. So why, first of all, the question is why NPV matter? Because it answers one simple but crucial question: is this investment really worth it in today money? That is one question that it answers. Is this investment really worth in today's money? Right. Now have a look at the time value of the money. Right. Yes, it takes into consideration the time value of money. Have a look at it. So it says that NPV fully respects the principle that 1 rupee today is worth more than 1 rupee tomorrow. It gives complete weight to the present cash, and that is key in smart decision making. So the question is, how does it work? Let's look at it. Let's look at the working of this NPV, right? So let's look at how does it work, means working of the NPV, right? So first thing first, we adjust for working capital. You can see the working capital adjustment. We always adjust for working capital. Suppose working capital increases, so that is a cash outflow. If it is decreases, that is called cash inflow, right? Obviously, right? Increase in working capital means cash outflow is there. Decrease in working capital means cash is coming in. So then we apply a discount rate, right? We apply a discount rate which reflect the risk and investor expectation. And there is a simple decision rule, as you can see is here, right? The decision rule is that if NPV is greater than or equal to 0, you should go ahead, right? The project creates value. And if NPV is less than 0, right? If NPV is less than 0, you should walk away. It is not worth the risk, right? So simple rule, NPV greater than or equal to 0, we should accept it. The project creates value, and if NPV is less than 0, we should walk away. It is not worth the risk. So among multiple projects, pick the one with the highest NPV, right? So highest NPV win. This is the simple rule that we have to follow while going through the NPV, net present value. Now one more question is that what about when asset having different lifespan? Yes, suppose asset are having the different lifespan. How do we solve this? So that is where equivalent annual cost comes into picture. It let you fairly compare option by analyzing the cost, right? So analyze cost to own, operate, maintain asset. It is useful for comparing asset with different lifespan. That is called equivalent annual cost. And one more thing is very, very important. It's called capital rationing. Yes, what is the meaning of this capital rationing? Let's understand. When funding is limited, we use inflation adjusted or risk-free discount rate and raise our threshold. So when capital rationing is helpful, when our funding is limited, so we use what? We use inflation adjusted or risk-free discount rate, like higher IRR cutoff, right? So capital rationing, I told you that when funding is limited, we use inflation adjusted or risk-free discount rate. Inflation adjusted or risk-free discount rate, right? And raise our threshold like a higher IRR cutoff. Now friend, if we talk about the pros and cons of this NPV, have a look. So on the left hand, on the right hand side, we have the pros, means advantage. Because the first advantage is that it captures the time value of money. It reflects the true value, profit or deficit, right? And it is closest to the real return, right? And if you look at the cons, which means disadvantage, that it is subjectivity in choosing the discount rate. Yes, obviously, because we use the discount rate, so obviously subjectivity is there. It is not objective. Also, long-term projection can be unreliable, and it also don't directly show the accounting profit and loss, because it has nothing to do with profit. It just show you whether your project is viable or not by looking at whether it is greater than 0 or less than 0. That's it. So to summarize the fact regarding NPV, we can say that NPV is a robust, realistic and reliable metric perfect for evaluating whether a project adds true value. Use it wisely and let your investment speak in today's value. So that is the power of now friends, let's look at another financial metric or another investment evaluation tool we have, that is called IRR, internal rate of return. Let's decode one of the most powerful tool of investment decision making, internal rate of return. What is internal rate of return? So basically this summation formula, you see, this is the formula that we use to calculate the NPV, right? Summation of CT upon 1 plus IRR to the power T minus C naught. See, what is IRR? IRR is the discount rate that bring your NPV to 0. So this summation of something is your NPV and you equate it to 0. You equate your net present value to 0 and the corresponding discount rate is called IRR. Means the discount rate that bring your NPV to 0. In other words, it is a rate at which your project just break even in today's money. And the formula is very simple. Summation of CT upon 1 plus IRR whole to the power T minus C naught. So what is CT here? CT is the cash inflow at time T, because for first year it will be C1, for second year it will be C2, third year it will be C3, similarly for each and every year. What is C naught? C naught is the initial investment, which means the outflow. Obviously you must have invested initially, that is the outflow, and T is the total project time. Capital T is the total project life, right? Or small t, whatever you call it, right? So and one more thing, IRR is the internal rate of return. So this is the formula that we use to compute the IRR. Now interpretation, how to interpret it, very important. See, suppose you got the IRR, how to interpret it, whether your project is viable, whether your project is worthy or not. See, simple rule is that if IRR is greater than RRR, what is RRR? Required rate of return or cost of capital. Whether you call it required rate of return or cost of capital, both means the same. So if IRR is greater than required rate of return or cost of capital, we should accept the project, and if IRR is less than the required rate of return, we should reject the proposal. Very simple. This is the simple way of interpretation. Now you usually calculate it through trial and error or use Excel tool to calculate the IRR, right? In examination you will not be asked to calculate IRR because it is very lengthy procedure, right? So just remember, you should compare IRR with respect to the RRR. If it is greater, then accept it. If it is less, then reject it. Simple rule. Now you usually calculate it using trial and error or Excel tool, and sometimes we can use option also. So out of the 4 options where IRR is given, simply put one option into in the place of R and check whether the result is LHS is equal to RHS. And if it is, then that is your answer. So using option also you can calculate the IRR, but be aware of its limit. What are the limitations? Let's understand. Pros we know, when we use IRR, because it account for the time value of money. Yes, it offer a clear benchmark. It compare IRR with your expected return or WACC. These are the pros, these are the advantage. But if we talk about the disadvantage, so the calculation is very complex because it often use software. It often needs software. In some case you may get multiple IRR. Yes, you may get multiple IRR, especially with non-traditional cash flow. Obviously, suppose your cash flow is non-traditional, you will get multiple IRR in that case. And IRR involve very heavy assumption. It is real result may differ, and if used alone it can mislead. So always validate with NPV, WACC or scenario analysis. So when to use IRR? It is based for scenario analysis. When cash flow are stable and predictable. I told you now, when cash flow is unpredictable, multiple cash flow is there, so it will give you multiple IRR. Just now I told you, right? In some case you will get multiple IRR with a non-traditional cash flow. So when cash flow is stable, predictable, then IRR is work based. And always remember, as a part of broader toolkit including NPV, RRR and WACC, right? So this is all about IRR. What is limitation, what is when it is used, how to calculate, every aspect we have covered now. Now have a look at this MIRR, that is called modified internal rate of return. Obviously this is a good version, a nice version of this IRR, right? So have a look at MIRR. So because why we talk about this MIRR, because the standard IRR has a big flaw, has a big limitation, that it assumes that all interim cash flow are reinvested at the IRR itself, which is often unrealistic. Yes, IRR assumes that all the cash inflow are reinvested at the IRR itself, which is itself very unrealistic. So MIRR fix it. How does it fix it? It uses the 2 practical rate. The first rate it use is finance rate, right? And the second, here you can see the first rate is used is the finance rate, which means the cost of capital, and the second rate is used is the reinvestment rate, which means the return on the reinvested cash. So these two flaw of IRR, which was unrealistic in reinvestment at IRR, right? So it has been corrected by the MIRR because it used two practical rate, finance rate and reinvestment rate. If you look at the formula of MIRR, here you can see the formula. The formula is very simple. It is future value of inflow divided by present value of outflow to the power 1 upon n minus 1, right? So future value of inflow, which means what? It means at the reinvestment rate, and present value of outflow at that. So I told you there are two rate, right? Reinvestment rate and the finance rate. So reinvestment rate assumptions and finance rate. So reinvestment rate means return on invested capital, right? Return on reinvested cash inflow, and finance rate is the cost of capital. So this formula we have to use: future value of inflow divided by present value of outflow to the power 1 upon n minus 1. So future value of inflow at the rate reinvestment rate, present value of outflow at the finance rate, and n is the project life. So this will give us the MIRR. Now comes the decision rule. See, again the simple thing: if MIRR is greater than the RRR, accept the project like we did in the IRR, and if MIRR is less than RRR, which is the required rate of return, then reject it. Now question is why it is better. If you talk about the pros here, advantage here, because it will eliminate the concept of multiple IRR. In the case of IRR, if it is non-traditional cash flow, we used to get multiple IRR. It often confuses us, but this confusion is totally eliminated by using MIRR, which does not have multiple IRR, and it offers realistic return assumption. It is perfect for project with non-conventional cash flow, but be aware there are some limitation also. It is more complex than IRR. It depends heavily on assumed reinvestment rate. So basically, in short, we can say this MIRR gives you a clearer, more reliable picture of a project profitability, especially when cash flow are uneven or tricky. So that is MIRR. And then we have profitability index. So let's understand the concept of profitability index. So what it is all about, let's understand using this particular diagram. So basically it is a smart tool that help decide, is the project really worth the money we put in? It is called profitability index, right? What is PI? So PI show you the cost benefit relationship of a project. How to calculate it? You can see the formula here. Present value of future cash inflow means whatever future cash inflow you will receive, find the present value and divide by the initial investment. That's it. We can also know, it is also known as a value investment ratio upon profit investment ratio or profit investment. So both are the name of this profitability ratio. Either you call it value investments. What you do, you see you have a future cash, you have the future cash inflow, you find their present value, right? You write in the numerator divided by the initial investment, and that is what you will get PI, right? Profitability index. Now profitability index concept is clear, I think, right? So how to interpret it? Suppose I get the PI, how to interpret it? See, if PI is greater than 1, it means we should accept the project because it is profitable, and if PI is less than 1, we should reject the project because it is not adding value. And if PI is equal to 1, it means it is break even, neither gain nor loss, right? So this is the importance of profitability index. And if we look at the application, so it is used in capital rationing. What is capital rationing? When funds are limited and only the best project must be chosen, that is called capital rationing. And for project selection also, PI is helpful, especially when comparing multiple opportunity. So to summarize about this profitability index, let me tell you that this profitability index help business prioritize project wisely, ensuring every rupee invested bring more value in return. Because in the denominator you are writing how much investment you have done, and in the numerator you are seeing the present value of all the future cash flow. So basically what you are doing, you are seeing that whatever rupee you, right, it is a smart way to evaluate the investment risk. So if we have to evaluate the investment risk, we have a very good model that is called Hilliard's model. So let's try to understand. When making investment decision, one key question that arises: how risky are the expected cash flow? Yes, obviously, how risky are the expected cash flow? This is one of the key questions that arise. That is where Hilliard's model, which was developed by Professor F.S. Hilliard, right? So this Hilliard's model developed by Professor F.S. Hilliard at Stanford, right, comes into picture. So have a look at the core concept of it. On the left hand side you will see the core concept. So this model uses a standard deviation of what? Cash flow, cash inflow, not cash flow, cash inflow. I told you na, it is a model to evaluate the investment risk, right? It asks how risky are the cash flow, are the expected cash flow. So we have cash inflow because we have make an investment, so obviously we will have cash inflow, right? Why we make investment? To have a cash inflow. So what it does, it for those cash inflow it uses the standard deviation. I think you know what is how to calculate the standard deviation of cash inflow. We have discussed in detail in AVM and BFM, right? So it uses the concept of standard deviation of the cash inflow to estimate the risk. Simple meaning, higher sigma means greater uncertainty and higher risk. Lower sigma means more predictable cash flow and lower risk. Simple it is. If a standard deviation is higher, it simply means uncertainty is higher, it simply means risk is higher. And if sigma is lower, means you know that if standard deviation is lower, it means you know we have more predictable cash flow and we have lower risk. So I hope this makes sense to you. You are already familiar with this concept of a standard deviation. Now then comes, we have perfectly correlated cash flow. Very important. See what is the meaning of perfectly correlated cash flow? If all the future cash flow move in the same direction over the time. I think you know what is the meaning of correlation. Two things are correlated. If suppose one thing move in one direction, other thing also move in the other factor also move in the other direction, in the same direction, then they are called perfectly correlated. So perfectly correlated cash flow means if all the future cash flow move in the same direction over the time, so they are called perfectly correlated. And this model assume the same risk pattern continues year after year. That means all cash flow behaves similarly over the year. That is what this model assume, right? It assumes that the same risk pattern continue year after year, right? So this is called perfectly correlated cash flow. And what about uncorrelated cash flow? Yes. For uncorrelated cash flow, on the other hand, if each year cash flow behave independently, so they are called uncorrelated. There is no correlation between the previous year cash flow and this year cash flow. They are called uncorrelated. And had there been any correlation, then it is called perfectly correlated. So in the case of uncorrelated cash flow, the Hilliard's model treat risk dispersion separately for every year of the project. So risk dispersion treated separately. So different approach for perfectly correlated approach and uncorrelated approach. And here is the formula. As you can see, for perfectly correlated NPV, that is called net present value. I think you are familiar with this formula. Summation of CT upon 1 plus I whole to the power T minus I, initial investment. And sigma NPV is given by summation of sigma T upon 1 plus I whole to the power T. Simple formula. What about uncorrelated? For uncorrelated, we have sigma NPV is equal to sigma T2 upon 1 plus I whole to the power 2T. Right, so this is the formula. So formula will not be asked, but you should know what is the meaning of CT. CT means expected cash flow over the year T. Sigma T is the standard deviation of year T. Risk free rate is small I. Initial investment is capital I, and project life is small n. Small n is the project life. Right, so this is the formula. Formula incorporate standard financial variables. So whether your cash flow are tightly linked or it fluctuate randomly, the Hilliard's model help quantify the risk so that investor can make better data driven decision. Obviously what it does, it is quantifying the risk. When I calculate sigma means a standard deviation, which means how much our data is varying from the mean. That is what a standard deviation tells you, right? How much it is varying from the mean, how much diversion is there from the mean. So diversion means what? It shows you the risk, right? If it follow the pattern, then it's no issue, but if there is deviation, it means there is a issue, and that is highlighted by this sigma, right? So this Hilliard's model help you quantify the risk so that investor can make better decision. I told you now, Hilliard's model is all about how risky are the expected cash flow, and that is what it shows in the investment decision. So I hope every concept regarding the Hilliard's model is clear now. No any confusion. Very good. Now friends, have a look at this risk adjusted discount rate. Very important concept from examination point of view. So when evaluating investment under uncertainty, not all projects carry the same level of risk, right? So suppose you are evaluating investment under uncertainty, so all project does not carry the same level of risk. That is where risk adjusted discount rate or RADR comes into picture. It is a very powerful tool that adjusts your discount rate to match the perceived project specific risk. So first of all, have the concept. So the concept, as you can see in the bottom, I have written, this is the concept. So it is noted by RADR. RADR is essentially a tailored discount rate. It is a tailored discount rate used in the net present value calculation. I think you know what is net present value calculation. We have already covered in the previous lecture. So in NPV calculation, you know, there is something called discount rate which is used, and this discount rate is used for discounting the future cash flow to the present value, right? So this RADR is used as a discount rate in the net present value calculation. It factor in not just the time value of money, but also the additional risk of a specific project. You know, the beauty of the NPV that it takes time value of money into consideration, and also so far as RADR is concerned, it takes time value of money into consideration, but in addition to that, it also take the additional risk of a specific project. How? So let's have a look at the formula, and it will be very much clear. So this is the formula: RK is equal to I plus N plus DK. So what is I? I is the risk free rate. That means the rate of government bond. Suppose you invest in the government bond, whatever rate you get, that is I. That is I. That is called risk free rate. Then what is N? N is the normal business risk premium. What does it mean? Obviously it means that since you are investing in a riskier project, so obviously you will demand some premium, right? So that is called risk premium. And what is called DK? DK is the differential risk specific to the project. Yes, I told you now, different project, different risk. So that differential risk is projected by this DK. So the sum of a risk free rate plus normal business risk premium plus DK, it gives you the risk adjusted discount rate. So I told you now, it takes time value of money into consideration, and also the specific project specific risk. Now have a look at the benefits. So what are the benefits of having these methods? So on the left hand side you can see the benefit. The first benefit is that it aligns project valuation with the risk perception. Very important. It enables comparison across diverse. Suppose we have many different projects and we want to compare them. So every project will have different DK, so we can easily compare at types and risk level. And also it helps the decision maker apply a structured approach to the risk evaluation. But you know, there are some limitations also. What are the limitations? First limitation is that the DK value is very hard to estimate and can be subjective. It is not objective, it can be subjective. For many different cases, different DK value can be there. And also it assumes that risk remain constant over the time, which is rarely the case. Do you think that risk remain constant over the time? No. It does not remain constant over the time. So this is one assumption that this particular model make, and this is the limitation of it. And also this model does not work well for rapidly evolving or highly volatile project. So you know very well that some projects are highly volatile. For those highly volatile projects, this model will not work, right? So these are the limitation. So every aspect should be clear. What are the benefit? What are the limitation? This is the peculiarity of this crash course, where we try to provide every information in a single page in the format of flowchart. In every unit you will see such kind of PDF, which will help you in final revision. You did not go through the lines of books, underlining every points, remembering every times again. No, just skim through this particular PDF and everything will be clear. Now have a look at the risk factor. You know, RADR is very useful for greenfield project, right? Project in a volatile market, tech innovation or innovative understanding. And if you look at the application, very important thing, see, firm use RADR to decide whether to accept a project or to reject it. How? See, if NPV is greater than 0, because you know this RADR, that is the risk adjusted discount rate, is used to calculate NPV. And suppose I calculate NPV and it is greater than 0, so I will accept the project. And obviously if risk is higher, RK will be higher, because RK is directly proportional to the risk. So NPV will be lower, because net present value is inversely proportional to the risk adjusted discount rate. And second thing is that if we talk about the real world example, so a company like Reliance apply it to replacement. So it means lower RK. Expansion means model. You know, in business every decision matter, and making the right decision start with focusing only on what is relevant. Welcome to Relevant Costing, a framework that help manager eliminate noise and concentrate on costs that truly affect the decision, right? So step number 1 is to identify the decision. Means before analyzing any number, define the decision at hand, be it price. So step number 1, we identify the decision. Step number 2, we identify the relevant cost concept, which means, you know, relevant costs are future oriented and avoidable. So this includes, what includes under relevant cost? It includes future cost, it includes differential cost, it includes avoidable cost. So these are the costs that will change depending on the decision you make. right? That's why they are called relevant cost, because if you change your decision, obviously the cost will also change. Future cost, differential cost, avoidable cost, these are the part of relevant cost. On the flip side, we have irrelevant cost, which are like sunk cost, which are like, past, or we can say sunk cost or past expenses which have already committed, so they won't be recovered, they won't change, and should never influence your decision making. Suppose for example, you buy a TV at 25,000 rupees, right? So tell me, 5 years ago you bought it, so will that change for if you for your to the context of your current decision? No, it will not change, the price will remain the same. So that cost of 25,000 is irrelevant, it is called sunk cost, it is called unavoidable cost, it cannot be avoided, right? If you change your decision, it will not affect, it will have no effect on that cost. So that won't be recovered, that is the main point, that won't be recovered or changed and should never influence your decision making. So that's why to this relevant cost concept, we divide into two parts: relevant cost, irrelevant cost. An example is given like sunk cost, past cost, unavoidable cost. And don't forget the opportunity cost. So if you are working with a scarce resource, consider what you are giving up, that is your opportunity cost. The potential gain from the next best alternative, right? That is called alternative cost, opportunity cost. See, a scarce resource you are working, opportunity cost will be there. If you are not working with scarce resource, no opportunity cost. So basically, what are the benefits is that it filters out the irrelevant data, it highlights the true cost implication, it is very vital for pricing, investment and strategic choice. So basically, the moral of the story is that by focusing on what really matter, that is called relevant cost, you empower yourself to make a smarter, sharper and more strategic decision. And this relevant cost concept is super helpful in, we are just going to discuss that activity based costing. Yes, in activity based costing, this relevant cost plays a super important role, ABC based costing. So let's understand this ABC based costing also, what it is all about. In today's competitive world, accurate cost information is foundation of a smart business decision. Obviously, if you don't have accurate cost information, you can't take a smart business decision, and that is where ABC, activity based costing, steps in. So what is ABC? Let's understand. So ABC is a method of assigning cost to a product, to a services or to customer. So what we do in ABC, we have service, we have methods, we have product, we have customer, right? We assign cost to them based on the actual activity they consume, right? Based on what actual activity they consume. So there is the second method is called traditional costing. Unlike traditional costing, it is not about spreading cost evenly, it's about precision. ABC definition is all about precision. Precision, hitting the bullseye, that is called precision, right? So basically what we do, we assign cost to product, we assign cost to services, we assign cost to customer based on the actual activity they consumed, right? So ABC costing helps to us to answer some question like, what are we really spending, where are we really spending money, which customer or product are driving the cost. If you look at the core concept behind this ABC costing, first thing is that cost object. Cost object means what you are calculating the cost for, like a product or a service, for which thing you are calculating the cost. Second thing is cost pool. Means pool, grouping. Whenever you see this word pool, it means grouping. So grouping of similar cost tied to a specific activity is called cost pool. Then we have cost driver. Driver means activity that cause the cost, like machine hour. Machine hour may cause the cost, inspection may cause the cost, order process may cause the cost. So cost object means what you are calculating the cost for, like you are calculating for a product or service, these are called object. Cost pool means group of activity, group of similar cost tied to the specific activity. And cost driver means what drive the activity that cause the cost, like machine hour, inspection, order processed, right? Then we have, if you look at the cost of type of cost driver, means the activity that cause the cost. It may be resource cost driver, like it measures how much resource is used, like time, labor, that is a kind of resource. Or it can be activity cost driver, it measures the frequency or intensity of the activity. So what are the steps under ABC method? First of all, we write the object, we define the cost object. I told you cost object means item that require cost measurement, right? What we are calculating cost for. First of all, we identify the object or cost, then we list all the activities, right? We map resource cost to each activity, that this activity will cost this much, this activity will cost this much, and then we allocate support cost via cost driver and calculate the total cost per object. The formula is very simple, that activity cost driver rate is equal to total cost of activity divided by activity driver quantity. So this is the formula that we use. What are the benefits of ABC costing? First benefit is that accurate cost tracking. So accurate cost tracking, improve project process efficiency, better pricing, better outsourcing decision, enhance customer and product profitability analysis. So example is given. For example, in a quality control department, costs should not be spread equally across product. So ABC assigning a cost based on actual uses like time, inspection, rework, giving a true picture. It's not like that you have spread the cost equally across all product. No, every product they consume different time, they have different inspection, they have different rework. So that's why you should assign cost based on actual uses. Now if you compare ABC costing versus traditional costing, so in traditional costing is volume based, means using units, but ABC costing is activity based, using effort and time. So result is that ABC costing is more meaningful, more actionable cost insight. Friends, if you want to practice numerical based on ABC costing, we have available in our question bank and also in our crash course. Separate videos are there to make you understand how to utilize this ABC costing methods using problem. We have also discussed in the live session. So that is all you need to know from unit number 12 and 11 and 12. And if you want such kind of videos for each and every subjects, you can enroll in our crash course program. In the description section of the video, you will get the link of the course and also WhatsApp number. Thank you.